Here we will learn to prepare asset disposal account when provision for depreciation account is maintained. For better understanding, let's take the example 3. As stated in the question, we need to prepare plant account, plant disposal account, and provision for depreciation account. First of all, let's have the formats. To begin with, the purchase of plant on January 1st, 2010 is recorded here and named as P1. Also, in the same year, a new plant, say P2, has been purchased. So it is shown here with the total cost, that is 7 lakhs. At the year end, that is on 31st December 2010, depreciation is charged at 15% on P1 and P2 and is shown here. Now, we close both the accounts by carrying forward the balances as balance CD. In the next year, that is 2011, these balances are brought down. Since no other information is given related to this year, depreciation is charged on these balances straightforwardly. So now we carry forward the whole amount of depreciation to the next year. Also, these balances of P1 and P2 are carried exactly the same. In the next year, that is 2012, the balances of both the accounts are brought forward like this. Now, during this year, P2 is sold. This will be reflected in plant disposal account like this. Now, we charge depreciation for 3 months, that is from 1st January till 1st of April. So we have this equation. That is 7 lakhs into 15% into 3 upon 12. Let's put this amount aside here. Next, we move on to compute the profit or loss on sale. We know that the value of P2 as on July 1st, 2010 is 7 lakhs. Now let's calculate the total depreciation charged on P2 till date. It is the total of 1,57,500 and 26,250. That is 1,83,750. Deducting this figure from the book value of P2, we get 5,16,250. This is the book value of P2 at the time of sale. However, the sale price of P2 is 4,92,000. Thus, clearly, there is a loss of Rs 24,250. Next, let's post all these figures in the plant disposal account like this and then close this account. Also, don't forget to show this 7 lakhs on the credit side of the plant account like this. Next, let's get back to the question. It is mentioned that a new plant was purchased. So, on 1st of April 2012, we debit bank account here like this. Let's name it as P3. Moving on to the year end, depreciation is charged on P1 for the full year, which is 3,75,000, and on P3 for 9 months, that is 1,12,500. Finally, both the accounts are closed. In the provision for depreciation account, first on April 1st, 2012, plant disposal account of P2 is debited with 1,83,750. This amount is the sum total of all the depreciation amount, that is, this 52,500 plus this 1,05,000 and lastly depreciation of 26,250 for 3 months. Similarly, on December 31st, for P1, the total depreciation is 11,25,000, which is the total of all these highlighted amounts. And lastly, for P3, it is only this year's depreciation, which is 1,12,500. Thus, the final depreciation amount is shown in the outer column like this. Now we move on to the plant account. This account is closed by simply carrying down this green highlighted balances of P1 and P3. Note that these balances are carried down at their book values. Thus, in this way, we prepare assets account and assets disposal account when provision for depreciation account is to be maintained.